Hey, welcome everyone to the Story of Trading Weekly Meetup. We got Asure Software, CEO of Asure Software here. We'll get to that in just a second. But first, a disclaimer, Story Trading is not an investment advisor. Investing in securities involves a significant risk of loss. We are recording this presentation tonight. It'll be made available to our Story Trading members for the balance of the week, and we'll get this uploaded to social media next week. So in just a minute, we'll bring to you Pat Goepel, Chairman and CEO of Asure Software, ticker symbol ASUR, last trade $9.83. That's roughly $200 million market cap. You know, what we like to do at Story Trading is understand the story behind the chart, right? We like to say markets are, there's a reason why stocks are trading where they're at. And by doing our research on things like sentiment, catalysts, fundamentals, and technicals, we can really understand the big picture, understand why the stock is where it's at. And the reason I wanted to bring this company on this week is because this stock has really outperformed. You can see here in the chart, up 50% since they announced Q3 earnings, and they actually hit a new 52-week high. So with that, I'm going to introduce Pat Goepel. That's how you pronounce your name, Pat?
Pat Goepel.
Pat Goepel over here. He's the CEO again of Asure Software. Also happens to be on the board of directors of Clearfield, which we know very well. So what I'd like to do, if you may give us like a 10, 15 minute introduction, however you like, however long you'd like to take, and then we'll do some Q&A after that.
Yeah, no, I came to Asure Software, 13 years ago now, ASUR on the NASDAQ. And the company at that point in time was a $10 million company, losing $10 million and 10 cents a share. And most companies that are in that kind of position probably never get through to the light of day. And it was definitely a turnaround story. I was nominated on the board of directors by a couple of the shareholders. And the good news was I was elected, and maybe at the time the bad news was I was elected. I was in to bring a turnaround in place. We had 50 employees, and we were a company that was IP related, and you would call it a patent troll, if you will, where they were enforcing the legitimacy of patents at that point in time, trying to remake themselves into a software background. I had run billion-dollar divisions of a company called Ceridian in the HR payroll space, Fidelity Investments, among having a career in the HR industry. So with that, we took off, and we started to get cash flow positive. We started to borrow some money to do some acquisitions. We had two line of businesses that we wanted to build around. One was conference room scheduling, and the other one was time and attendance scheduling. We got out of some of the money-losing businesses around video conferencing, real estate, et cetera, and we really focused on software. The first thing we did was focus on the cloud because we saw that as an emerging trend, and we built two lines of businesses. We took the conference room scheduling of scheduling real estate, and all the way from its humble beginnings of a $5 million revenue business where you had to resell $4 million just to break even in the old perpetual software model to a software model that was reoccurring in the SaaS environment. And what we did is up until December 2019, we took that line of business to $30 million. And we ultimately sold that business for $121 million to Excel KKR FM Systems. And for that, it was a great exit for the shareholders because we were able to book a $90+ million gain. So we were able to do that tax-free for the shareholders. And then the other line of business was time and attendance. And in 2016, we made a huge move that got us into the human capital management business. And what we did is we bought a developer-led business in payroll, and we started to cross-sell it with our time and attendance business. We also added tax filing. We added human resource compliance consulting. And so we built that business in the human capital management. And now, as of today, we serve 80,000 clients in the United States. We sell 15,000 clients, about 400,000 employees in a direct sales environment where we contract with small businesses all over the United States. And then we also have about 80,000 clients in an indirect relationship, and that's about 800,000 employees. So overall, we serve about 1.2 million employees, about 80,000 clients in totality. We're guiding to 98 to 102 million dollars next year, and really have built the business from its humble beginnings of 10 million or 5 million in this space to now $100 million business, and about 15% EBITDA margins, have a lot of momentum, where we just announced the third quarter that you mentioned, where we growing double digits, and profit looks good, and we're accelerating and think we're hitting our stride. So it's ASUR in the NASDAQ, a humble beginning story. I own 5% of the company. I've never sold a share. And then recently in August, I bought 100,000 shares to go to about 1 million shares, and really to show effort and strength that I believe in the company, and believe that the best days are to come.
Good stuff, Pat. I'd like to go back to and focus a little bit on where you fit into the market. You know, I was taking a look at what you do, and generally speaking, it sounds like payroll services, although you got a little more specific than payroll services. So I'm familiar as a small business operator. Originally, I used to use ADP, and then over time, I switched to Paychex, and then I went to Square. So those are the big three I'm familiar with. So can you kind of compare and contrast what you guys offer versus Paychex or Square?
Yeah, absolutely. So what we do, first of all, in our 80,000 clients or so, direct and indirect, we provide payroll services, time and attendance, tax filing, and HR services to the small business owner. We help them grow. Our average client's about 20 employees or so. So the companies that you're familiar with, we see them every day from a competitive landscape. About 60% or so of our businesses that we get come from those valued competitors. And what makes us stand out, we're a national business. We're the 6th largest payroll company that nobody's ever heard of. And we really cover the United States. We focus and sell through not only a direct sales force, but we also sell through what we call influence centers, whether it's a benefit broker, a banker, a CPA. We primarily focus on tier 2 and tier 3 cities. We feel that if we can build strong relationships, get people up and running quickly, and really serve them well, there's plenty of room to grow in those businesses. Some of our business does come where a small business owner just doesn't have the expertise or doesn't know where to go to, but we'll provide a software solution to get them up and running in sometimes the same day. And then we'll have the expertise where we'll help them make those decisions on being HR compliant or payroll compliant with the government, the federal agency, the state agencies, as well as the local agencies. And we have enough time to ask the right questions to help them with their compliance, but also, more importantly, help them grow, because the small business owners have enough trouble getting funding or trying to serve their clients. The last thing they worry about is to keep track of payroll taxes or banking laws, et cetera, and we help them with that.
Okay, that's interesting stat. Greater than 60% come from your competitors. Do you have any kind of further insight into, are they coming more from ADP or coming more from Paychex or Square? Or others?
ADP and Paychex are the predominant. Sometimes in a software solution like Square, they come to us for tax filing and some of the expertise that we can provide around that. I would say our biggest takeaways are definitely ADP and Ceridian, and you would expect that because they're big companies. They're fine companies, but we have a niche that we think from a technology perspective, we're a little bit more nimble. And then from a local servicing perspective, we know their names and can serve them really well. So those are our competitive strengths, is really that we can get them up and running quick with newer technology. And then we also have the expertise to help them grow and take advantage of their back office, where they just want somebody to help them with that minutia around compliance so they can grow their business.
Right. Okay. So is it fair to characterize ADP and Paychex as more legacy businesses for larger companies, and you're taking share from them for the small business side? You're more directly competing with Square in that sense. Does that sound right?
Yeah, I think in general, ADP and Paychex have divisions of small businesses. We're absolutely competing with all three. ADP and Paychex tend to be a little bit more legacy in their approach or their model. As far as Square, we're able to not only compete from a software perspective, but also have the expertise to deal with their small business questions. And we're focused with an average client size of 20 employees. We're focused in the small market, but we do serve small and mid-sized businesses across the United States.
Okay. All right. So this projection for 98 to 102 million, is that, when he said next year, did he mean 2023 or 2024?
I apologize. I probably didn't turn the page on the calendar. So it is for 2023.
Okay, great. So that, can you give us an idea of what market penetration where are you now in terms of market penetration, and what kind of market penetration that would, in terms of the competitor pie, that would represent if you get to that target of roughly 100 million?
Yeah, I mean, we still have a long way to go. We think we're, obviously got momentum where we're organically in the third quarter, we grew over 10% organically. Our guidance in the fourth quarter and next year are double-digit organic growth. We believe with jointly about 80,000 clients that, we are still, that we're taking share and have the ability to take share in the future. We have a couple different models where we can resell the solution to independent payroll providers, but we can also sell direct. As far as the market share perspective in small business, probably have somewhere around 6 to 8%. Feel like we can really take share both organically in the businesses we serve, as well as with multiple products. Our average client today, if we in a new sale environment, takes about 3.8 products. Our legacy base has about 2 products per client. So we have a big cross-sell opportunity in addition to the market share opportunity that we have. And then the space in general is growing about 7 to 8%, according to some of the IDC and some of the thought leadership in marketing.
Right. So we say 6 to 8%. That's based on your current run rate of right 22 million in Q3. Is that what that's based on?
No, the 6 to 8% is more the overall market spend, which is, as much small, medium, large, you could go to about $40 billion in market opportunity. We focus on primarily the small business side of that. And then as far as, we're pointing in a market that's growing 6 to 8%, we are pointing to double-digit organic growth, which is 10 to 12% in some of our guidance going forward.
Okay. All right. But just to clarify, the share of the, I guess you characterize it the small business market share, 6 to 8%. You estimate you have 6 to 8% of the small business share today, or is that your year-end target?
No, we believe that how we define small business is about 6 to 8%. And there's some noise in the number based on how many products and services. But if you just take a look at the 80,000 clients that we have, both direct and indirect, you can back into a number that's about 6% or so of the overall share. When you add some of the products and services that we can cross-sell, you have that opportunity to even do better than that.
Okay. All right. Got it. So I wanted to go back to after the Q3 report, a couple analysts came out with really glowing reports really kind of a tone that sounded like you guys had reached some sort of inflection point. I wonder if you can speak to that. What really changed in Q3? And I don't know if you agree with those analysts, but are you at that? Did you reach an inflection point during Q3, and why was that? What is that inflection point, and what does it mean to the company's bottom line going forward?
Yeah, I mentioned in December of 2019, we had a pretty compelling event where we sold the Asure space business, or the conference room scheduling business, and it was about a $30 million division at that point in time. At that point in time, in December of 19, we had a human capital management business that we grew from almost less than $5 million, and we said, hey, we're going to build the whole company around human capital management. And in December of 19, we had about 33 salespeople at that point in time. And we came out with guidance that said, hey, we're going to grow organically double digit by about, really as soon as possible. And we said we're going to hire some salespeople to get to 60 and 70 salespeople at the time. So in effect, almost doubling the salespeople to get the organic growth engine going. Well, what do you know? COVID hit, right? So we had a $70 million business that almost immediately was in the 60s because small businesses were dealing in March of 2020 with COVID. And at a point in time when we were hiring salespeople to grow the business. And the beauty of our business is it's about 95% plus reoccurring or repetitive revenue. So we started to grow. And in 2020, we obviously had a tough environment with COVID. We took some pay cuts as a company and really worked through the COVID issue. And then in 2021, we really started to get traction with the salespeople. Right now, we have close to 90. And then what happened in 2022 was we still, we really grew the salespeople, but more important than that, we grew our results. And, we kind of put a flag in the ground and said, hey, in third quarter and fourth quarter, we're going to start to have the metrics to support double-digit organic growth. And what happened then is we did that. And so I think people really were pleased that we set out to do something. We took it in the chin for a year with COVID, but we continued to hire through COVID. We continued to perform well, and we got the top line to double-digit organic growth. At the same point in time, we're getting increasingly bullish on our EBITDA margins. And so to plant a flag and say, hey, we're not only going to do $100 million, but we're going to do that with 14 to 16% EBITDA margins. And we've had some healthy growth in EBITDA. Now the investors are seeing, wow, okay, we grew organically. We built a business. We said we're going to do it. We've done it. And not only that, but we've added profit as well. And, for us, we're in a high fixed cost business. So what I mean by that is if you make a tax filing change, whether you have one client or 80,000 clients, it's the same change. And so for us, as we've gotten size and gotten growth, it's just very clear that the profit is starting to flow into Asure. And I think investors feel pretty comforted that that plan that we've announced over the last couple of years has come to fruition. That being said, we also are really bullish that the best days are ahead of Asure, not behind us.
Okay, great. I just want to remind the audience that there's a good time to do it. If you have any questions, you can start putting it in chat or raise your hand and we'll get to you. In addition to everything you talked about, I also noted, and maybe clear this up for me, because you talked about hiring more sales reps, but part of the bullishness I'm seeing in these analyst reports are a cost savings plan that's supposed to reduce annual costs by like $5 million over the next 18 months. Can you help us reconcile the two? You're growing your sales, but you're also reducing headcount. Can you catch us up with that?
Yeah, no, that's a great point. We've had some operational initiatives. And if you think about how we grew, and we mentioned we grew by some acquisitions where we bought some of our resellers. And, if you think about a reseller, whether they were in Rochester, New York, or Burlington, Vermont, or Omaha, Nebraska, or Nashville, Tennessee, we first of all can serve customers nationwide and have regional centers. When you look at nationalizing the business, what we were able to do is we put all our software in a common instance of AWS or Amazon Web Services. That was able to save us some money and save the clients money and give them better performance. What we also have done during that period of time is we used to have 120 bank accounts where we reconcile with the IRS, the state agencies, and payroll checks at a local level. What we've done is nationalize that, and to where now we have under 20 bank accounts nationwide, where we used to have 120. That alone saved us a couple $1 million in operational efficiencies. Now, what that also did is, our model is such where, we'll take the dollars from an ACH exchange or a payroll exchange from the company, and then ultimately pay the employees with a couple days lag. So what we do is we have a float opportunity where not only do we take those dollars, but then what also we pay for those small businesses, we'll pay and be responsible for the accuracy of the timeliness of the tax filing payments. And those payments are due anywhere from the next day to sometimes as much as 90 days later for local agencies. We're able, and you can see it in your businesses with float or interest rates, we're able to get some money on those rates. So we have about $200 million plus of daily balances. If you think about in your own business or your own company, you weren't getting many dollars a year ago or 2 years ago. Now you have the opportunity, let's say at 4%, at $200 million. Now that's $8 million to the top and bottom line. So it's part of the business model in the human capital management industry. And we're in a great cycle given that. So a number of different initiatives, AWS, the banking cycle, the closing of bank accounts, a common instance of the software. And then we're just getting better. We weren't even in the human capital management more than 7 years ago, and we built this into a $100 million business. As you mature and nationalize the business, good things happen in a business that can scale. And we've reached now the first threshold of scale where we have line of sight ultimately the 20% plus margins. And then as we continue to grow, we think we can even do better than that.
Very, very interesting. That's something actually I didn't think about or knew about. That's pretty exciting. So that may explain as well, with interest rates going up, part of why your stock's been doing well. So speaking of line of sight and profitability, actually, I didn't look into this. Can you tell us where you are with your cash position and your runway, and as your profitability improves, what you might do with that cash?
Yeah, from a cash perspective, so we have a cash position somewhere in the teens right now of cash that we have available. We have about 30 million of institutional debt, another call it 7 million or so of seller notes that were on previous acquisitions, where we use that as an indemnification hedge in case we want to settle up from those acquisitions. So 37 or so million of debt, about 15, 16 million of cash right now. From an EBITDA perspective, we believe a non-GAAP EBITDA somewhere around 14 to 16%. That translates into about a $6 to $8 million positive cash flow. We have opportunities to grow by acquisition, and we have opportunities to grow organically. And so that's, we think that there's positive developments that we can put cash to use as well. And then because it was a high fixed cost business, if you think about where we were in 2020, we were in the $70 million range, and EBITDA was about 8%. Now that we have line of sight to $100 million, EBIT is at 15%. Dare I say we go to 120 in the following year. You have line of sight almost to 20% EBITDA. So you're at a point where we've crossed the chasm of fixed costs and we have the opportunity to earn real margin.
Okay. All right. That's good. As far as the cash flow, I don't think you were cash flow positive yet, right? In that Q3 you just reported?
We are cash flow positive. And if you look at the operational cash flow, and if you look at, because we've done some acquisitions, we had depreciation and amortization expense. But if you strip all that out, we're cash flow positive. And then fourth quarter, and it's a phenomenon every quarter, we get a lot of the W-2 cash. We report that in earnings on first quarter, but we will be cash flow positive both in 2022 as well as a healthy amount in 2023 that I mentioned.
Okay, great. All right, I do have a few more questions, but let me switch to audience question here. Chris asks, can you talk more about your pricing model? Heard that 95% is recurring. What percent of revenue is from new businesses versus winning from competitor? Is bad debt or risk of that's too. All right, let's just take that first question. We'll come to the second question.
Yeah, well, first of all, just on the bad debt, because we take the fees up front, we really don't have much bad debt. So that's one opportunity to kind of take off the table. As far as repetitive revenue, we have a model in our IR deck that's on the website, with ASUR but it walks through the model. But 95% repetitive revenue. Usually we get about a 3% price increase. We have the opportunity to get 3 or 4% revenue growth from our float that I talked about. From a new bookings perspective, usually we grow about 10 to 15% in new bookings. We lose about 8 to 10% of our reoccurring revenue each year. So we have healthy retention rates around 90 to 92%. And then all that equals to a double-digit revenue growth of 10+%. So the revenue gets very predictable. We have an organic opportunity that I just walked through. We also can acquire some of the resellers. We have a goal to increase those acquisitions by another 10% of revenue. And then because we're in a high fixed cost business and our revenues are very predictable, we know how many employees can serve our customers. We do a great job of hanging on to them. And we built some national scale now where, every customer that we add becomes a little bit more profitable in the numbers that I mentioned. And we think we have that opportunity going forward.
Okay, Chris, I think that answered most of your questions. I don't think you talked about your pricing model. Did I miss that?
The pricing model is usually a per employee per month model. And so if you think about it, payroll on a yearly basis, let's say, our average client, let's say is around 20 employees, from kind of a $200 per employee per year. 20 employees would be roughly $4,000. And that would be time and attendance, payroll, human resources, compliance, as well as tax filing dollars. And it's a highly repetitive model that I talked about.
Okay, great. So, one of the things, I'll get to the other questions in a second, that kind of surprised me at first when I looked at this. I'm like, oh, you're in the payroll space and the stock is like at a 52-week high with everyone worried about recession. So my very first instinct was, this is not a stock I want to be in, as we might be entering recession and we're seeing layoffs and big tech out in Silicon Valley. So I wonder if you can speak to that a little bit.
Yeah, this is, I've been in the industry 35 plus years. And, I think first of all, this pending recession, if that's what it is a little bit unique in a couple things that, having gone through this at different companies. First of all, there's a unique dynamic that normally in a recession, people are cutting interest rates. Well, we're not cutting interest rates in this environment. Interest rates are actually going up and, are very healthy increases. So order of magnitude next year, that'll probably add 3 million top and bottom line to what we currently have in our revenue model. So that's a very positive development, and interest rates are going up. Two, what's a little bit unique now is there's about 7 million or so more jobs than people in the small business area. I view right now that we have a little bit of a tech recession or a white collar recession. If you think about small businesses nationwide, what's interesting about them is they still can't hire enough employees. We have a daily call where we talk to all of our what we call branches or hubs, and we have a daily call down of number of payrolls and what are some of the issues. And overwhelmingly, still small businesses in the United States want to hire, and they want to hire more people. So when we think about it, a recession might actually be good, because what's happened since COVID is you have secondary spouses that have left the workforce because they've had to take care of their kids, or they've had to take care of their parents with homeschooling or COVID or what have you. Also, when we look at the demographic of people that are 55 to 64, some of them have retired or were forced out. Well, now that their 401k might be a 301k or a 201k, they might want to go back to work. So we actually think a recession might be good for our business, which might be counterintuitive, but that's how we're looking at it right now. So we think we have big opportunities going forward. The sales environment's been very positive. We have achieved the last 2 quarters 87 and 91% sales growth. So a lot of that revenue is going to hit the beach, and we feel really good about the demand environment going forward. Now, we're not immune to a recession, but when you think about some of the factors that are out there, if people still want to hire, that's positive for us. Interest rates are positive. And then from a sales environment, even if you have tough times with the recession, a lot of times you're going to want to invest in automation and invest in partners that can make it easier for you. So plenty to feel good about in a potentially tough environment that's coming up.
Nice, good insights. I got a question here from the audience. Assuming your competitors are noticing your success, what kind of countermeasures are you taking, and how vulnerable do you think the company is to competition?
We're pretty nimble. We have really good people. Our people are our best asset. We played for this moment for a number of years. I've run personally a couple billion-dollar divisions of big companies. I know what good looks like. We have a really good management team that's focused. We have a good mix of tactical and strategic execution. Our competitors are great competitors, and they're really good companies, but we feel that, we're pretty nimble, and we think we have the opportunity to take some market share. So we feel really good about where we are.
Okay, great. I want to take, let's look forward a little bit. If you can talk a little bit aspirationally, 3 to 5 years from now, what are some of the opportunities that could maybe be a step function that could maybe, instead of just doing your 10% or 10 to 15% growth a year, maybe all of a sudden go up 50% one year organically? Is that possible? Or maybe it's through acquisition. So what are some of the big ideas of upside potential 3 to 5 years out?
Yeah, you sound like a board member right now. No, I'm teasing. So a couple opportunities. First of all, our unique area where we have 200 resellers, we do acquire some resellers, and the beauty of our model is we can acquire them, but we're using the same technology. So we have an opportunity to grow organically as well as by acquisition. And what's unique about us is because the resellers are on the same technology, the client doesn't have to change in that area. So acquisitions are really easy for us to do. And we feel like we have an opportunity to grow both organically as well as by acquisition. We also launched something in the first quarter this year that's got a lot of investors excited. It's around a marketplace. We pay about $1 million to employees. I mentioned about 80,000 clients, indirect and direct. One of our first major models was we did a partnership with Equifax. And if you think about the Equifax relationship, first of all, if an employee wants to get a loan, they apply for a loan. Equifax will service or tell the loan company if that employee, first of all, they'll do in the old world, they'll do the phone calls to the employer to say, hey, is so and so worthy of this loan? Are they still employed? What's their W-2? What's their overtime wages? And they ask a lot of questions to make sure that the employee can pay back that loan. Well, first of all, in that environment, Equifax has got to hire people to do those phone calls. The employer doesn't always like taking those phone calls because they have to look up all the questions I just asked, and they have to take a half hour out of their day. The employee sometimes doesn't really like the fact that the employer is getting that call, because now they know their business and they know, hey, why'd you apply for food stamps? Why did you apply for a loan, et cetera? The beauty is we sit on that data. And if you think about payroll, it's a very data rich environment. You got salaries, you got hours worked, you have termination dates, you have hire dates, et cetera. So we can provide that data if they opt in, and we can provide that in a frictionless environment. Equifax has paid us roughly $5 million a year in order to deliver that on an electronic basis, and everybody wins because they save time. Now, if you play that forward, we have an agreement with H&R Block. We have an agreement with other kind of partners that we're going to roll out, and we believe this is a tremendous line extension to growth. To your question, 3 to 5 years out, we're ultimately 30-50% of our revenue could come from the marketplace. And we provide that service to our employees and clients alike. And they like it because those are services that small businesses can't get on their own, but we can provide it in such a way where, we get revenue, but we also provide value to the employees we serve as well as our clients.
Very, very interesting. One follow-up question I had on my mind regarding acquisitions is the timing of that. Is it something you'd consider? Your balance sheet doesn't look so robust right now. You're cash flow positive. That's good. But is that something you'd consider this year? Or you want to kind of shore up your balance sheet first after a great 2023? What's your thought process behind that?
Yeah, in 2022, we wanted to pop out the business model of really accelerating growth, show the organic growth, as well as show the margin improvement. We'll do that in 2023. We'll start to look to be opportunistic in the second half of 2023 and 2024. We believe we have some opportunities. We did acquire about 18 or so resellers over the last 5 years to get in this space. It was important for us to get critical mass and cover those fixed costs. Now that we're in this model, you'll see a combination of organic growth, cash flow, as well as some acquisitions over time. And we think that's a good strategic leverage of how we want to grow in the future, and see no reason why ultimately we can't be, a company that, can get to from 100 million to, let's say, 500 million over time. And in just kind of insight on that, if we acquired every reseller we had, we would add probably about 300 million to our revenue base. So we're not going to acquire them all, but we're going to drive around our platform of technology and drive growth organically and inorganically. We'll do it in a way that shareholders can win, as well as we can drive value in the small business marketplace.
So I appreciate your transparency and your thinking on that. That was awesome. All right, we got a follow-up question from Chris regarding competition. What's the level of effort for a customer to switch from a competitor's platform to Asure? And what are their top reasons for switching? Is it pricing? Is it functionality?
Yeah, no, great questions. And I want to explain something for a second, because first of all, payroll, if you will, is what I'll call a negative satisfier business. So for 80,000 clients that we provide tax filing services for, and I'm kidding a little bit, But if I go to the mailbox every day, I'm continually disappointed, right? And it's because nobody's ever sent me a letter and say, hey, Pat or Asure, great job on those taxes, right? I've never gotten that letter. But if something happens where you have a notice or potentially a lien, boy, that small business really wants to have a partner that'll be responsive and really act in good faith on their behalf. So when you think about our business, if things are going well, it's really hard to get people to change because it's a negative satisfier business. If everything is going well, they don't want to mess with somebody's payroll or they don't want to mess with the CEO's pay. They just want it, hey, I'm a happy guy. Now, why do customers switch? Sometimes it's technology. They get behind in the technology cycle and they want to switch for newer tech. Sometimes it's, how you can get that data to their third-party providers. So Paychex and ADP, for example, are now in the health insurance game. Well, some benefit providers don't necessarily want their payroll company to compete with them. So they'll come to us and say, hey, can you get us the insurance data that we need automatically, and you're not going to compete with us. So that's an opportunity for us to win on behalf of the client where we can share data to make their jobs easier. Overwhelmingly, the three reasons they switch is better service, better attention, and better technology. And that's proven out over time.
Better technology than Square. I can imagine it's better than ADP or Paychex. I've been through both of those, but Square is pretty good technology.
Yeah, Square is awesome technology, but if you think about your federal government, your state government, and your 10,000 locals, and you think about all the rate exchange information, so when you think about Square at a client level, really sexy technology, but if you think about where all that technology has to go and the expertise in doing rate exchange with the state of Michigan around unemployment compensation that changes every year and it might change differently by county, the question would be, are those automation on the back end really as good as something as Asure? And so what we find is the technology not only has to show well in front of the client, but the back end technology that's API driven and has the hooks to all the areas where the data needs to sit and go on behalf of the customer. We think we have a really good combination of technology and expertise to serve our customers.
Awesome. Sounds good. Guess I'm done with my questions, except, if there's any other things you want to add, the only other kind of housekeeping note is, I guess your quarter four ended December 31st, right? So I guess in terms of catalysts coming up, you have your earnings report. When is that going to be?
The earnings report, we're still working through the details. Right now, I think if you look at Yahoo Finance, it'll be Monday. I think it's March 7th or so. We may have a potential to beat that, but right now that's kind of where we're slated. It could be as early as late February, early March, but that's where the next earnings report is. And then our fourth quarter guidance was very strong, and we'll announce that at that point in time. But I think a lot of people were very interested just because the third quarter was a big step up. Fourth quarter was a step up. I did mention in August I bought 100,000 shares, and I think people took note of that. We invest as a management team and a board right alongside the shareholders. It's all common stock. Really believe in aligning all our stakeholders to that. And the performance has been positive. I think we have a lot of good momentum in the business. Bookings have been very strong. So, I encourage you to take a look at ASUR, Asure Software on the NASDAQ.
Hey, thank you, Pat, for your time. Really appreciate that. And I think for our audience here and whoever's watching on the YouTube here, I think we have a much better idea of the story behind this chart and why it's been performing great recently. So really appreciate that. And if you're not StoryTrading VIP yet, you can hop on over to StoryTrading.com, get a 7-day free trial so you can catch all of our CEO interviews. Pat, thanks again.
Thank you, and appreciate everybody's time. Have a great day.
Thank you. You have a great day too, and make sure to follow us there on YouTube and on Twitter. Have a great day, everyone.